Good morning, everyone. Before we get started and I do my open, please take a look at this.
A global leader in insurance broking and innovative risk solutions, Marsh provides personal and business insurance solutions to protect our clients' businesses for future growth while offering lasting peace of mind.
Thank you so much to Marsh for this morning. So Marsh this morning is our proud sponsor and the partner that is really assisting us in taking our event to greater heights this morning. And again, Marsh, thank you so much for your continued partnership. We really do appreciate it. And Marsh, of course, being the main sponsor for our conference later in September, which I'll talk to in a minute. This morning, such a crucial event and a really big topic. I mean, at the moment, we're all worrying about the third wave. We're seeing again the concern personally for health of ourselves, of our colleagues, of our families and friends. And, we're sitting in a position very similar to last year during winter where we're watching numbers increase and we're worrying. And if we think back to Prof. Ian Sané a few months ago when we spoke about the second wave and then he spoke about it again at the beginning of the year, one of the biggest messages was that this third wave was going to be much bigger than the second wave. And I'm sure you'll all recall that. And we all started thinking, oh, but things are looking so much better. We're feeling better. We're getting back to normal. Business is looking so much better. Our teams are enjoying themselves again, being able to interact a little bit. And here we are, boom. We are in this third wave and we are watching very nervously and anxiously again as we see the numbers increase. And so it makes us think, of course, the personal risk of our loved ones and ourselves. But then, of course, again, what will the impact be on business? What are we going to experience now? Yes, knowing what we learned last year, we saw the impact of the economy in 2020. We saw the impact on business operations. And we saw how we very quickly, we had to be flexible. We needed to respond very quickly. We had to have extreme resilience to ensure that we enabled our organizations to be able to walk into and continue into this uncertain landscape that we find ourselves. And so the insurance industry in the last year has been exposed to greater and more complex risks than ever before. I mean, the landscape has changed completely for this insurance industry. We've seen it, you are feeling it. And so we're really having to consider and look at how we control what needs to take place. And this has really seen the need for more active risk management in the insurance space. And with our risk professionals understanding insurance and our insurers having to understand risk management more optimally. And hence why discussions like this today are so important. At URMSA, we've seen the need and we've been watching the landscape. And of course, many of our members are linked to the insurance industry, are in the insurance industry, are brokers or are risk professionals that deal with insurance, of course. So we are having to look at this very carefully as well. So one of the areas where we've started looking is within our guidelines. So you'll recall the URMSA guideline in 2014, where we look at that code of practice or the standard of risk management for South Africa. That was in 2014. So we've seen changes in the industry. We've seen risk management evolve, and we've seen this integrating of risk management and strategy. Risk management has evolved so much, particularly in the last year. And we're looking at business continuity, management, resilience in such a different way. And then, of course, insurance and operational risk management, how it is being driven at the moment. So within our guideline that is going to be launched late in the year, and again, partnered with Marsh. So thank you to Marsh. We are looking at, that is one of the areas of the guideline in terms of insurance and operational risk that we're also going to be including in the guideline, the updated guideline. So that's going to be a huge guideline that we launched later in the year. You can hear that it's got very different nuances, very different drives as well. So something to look out for as members and as risk professionals and insurers as well. That is going to be important. And then, of course, as an URMSA, as the professional body, we are looking at as well, how do we support those that need more understanding of risk management, that can support the insurers that they work for? How can they optimize their own roles at the moment? We see the absolute value and importance. So this morning, we are looking forward to these discussions because it really does help us inform and navigate this journey that we are on. So a huge thank you to everyone for being part of our morning. We are really privileged to have the speakers on our program this morning that we do. So first of all, we've got Chris Britz, who's very, very well known in the insurance and risk management arena. Chris has been, from my journey at URMSA, Chris was on the executive committee. He sits on several committees. He really is that voice of reason often. He is the managing partner for RiskOnet Africa, which is a risk management advisory and management consulting firm. So Chris will be facilitating this morning and taking us through the program. And the reason Chris is facilitating as well is that he's going to be asking the right questions, the questions that we've all got. And then, of course, you've got your chat box on the side. So Chris is your voice for the morning. So please make sure that you ask your questions that you need answered, because Chris is going to do that. Then from there, we've got Thokozile Mashlangu, who's the CEO of the Insurance Institute of South Africa. And she will really be adding value from their point of view and what their members are finding at the moment. And then, of course, from Marsh, we've got Jane March and Terashni Pillay. And then from Allianz, we've got Darlington Munhuwani. And then from Sanlam, we've got Deolinda Del Carme. So we've really got amazing speakers that are going to be sharing with us this morning. But before we get into this webinar that is of so much importance, I just want to remind you a couple of things, and my team has asked me to give the following messages. So the first thing is that the award nominations are open. So if I'm looking at what we are talking about this morning, and the challenges that we faced last year within this industry, I have no doubt, and I've seen amazing stories and case studies coming from the insurance and risk industry with this operational risk topic, organizations that are doing brilliantly. And I know that with the awards that we should be getting nominations around this for individuals and for team projects. So please give thought to that, because I think it's really important. And I think after such a terrible, terrible year, and where we're sitting again looking very anxiously, let's give thought to those who really need that acknowledgement, who deserve that acknowledgement, actually. And let's get that nomination sorted. The nominations, we will keep reminding you about the closing date, and then we will be closing and announcing the winners and awards. And it's not an evening this year. It's going to be a very different event. It's going to be an executive event during the day in November. So we're completely changing the face of the awards. It's incredibly exciting, and we're going to be having satellite networking events around the country so that the members don't need to travel to a venue. We will also be going digital as well. So that's something huge to look forward to. And then I spoke about, of course, the conference. The conference registration will be opening within the next week. And again, it's going to this conference, the way that the program has been designed, incredibly exciting. It has been designed aligning to the South Africa Risk Report. It'll link to the guideline, and it links to the curriculum for the qualifications and certification of our board exams as well for the CRM Prac and Prof, and looking at the 8 competencies for our risk professionals. And so this very, very dynamic conference program is going to be able to speak to all your needs, which I'm really looking forward to as well. And then, of course, the board exams, so the certification exams. Please don't forget that if you are able to meet the criteria for board exam 2, which is your certified risk management professional, which is that CRO, that senior risk management level, you need to see if you meet that criteria because you are able to apply for exemption and you don't need to do the CRM Prac exam. So please take a look. I'm going to remind you that the closing date for the board exams, we're looking at the CRM Prof, which is board exam 2, the higher one, closes on the 2nd of July, and then certified Prac board exam 1 closing on the 9th of July. So please make sure that you get those registrations. Those exams, the board exam 1 will be hosted in October. So from July to October, there's your preparation time, and the CRM Prof, a Prac exam, board exam 1 will be in November. So again, from July to November, your time to prepare. So good luck with that, and please have discussions with our team. And then finally, our training. We're really excited at the moment. I mean, we are doing online. We're looking at August, hoping that the numbers improve, where we will be able to offer hybrid training. So hybrid training meaning that we'll have some people within our training room, but people around the country as well, and coming in and out and having amazing interactive sessions with people sitting at their offices or at home, people in the training room with a facilitator. And our team have just been so crafty and smart with the way that they've put this together. So really looking forward to that. And so we're looking at the August training on risk, appetite, and tolerance to be the first training session that we do in this hybrid fashion. And so that's so exciting with what's been planned. Now this morning, please use the chat box, as I said, to ask your questions, to comment, to share. And then Chris Brits, of course, will be picking on any comments or questions that you might have. The hashtag for this morning on social media will be hashtag live with IMSA. And there as well, please have conversations because we will be very active as always on social media on the various platforms. And then finally, I think that this is the cherry on the top. And I see that the team have been very, very generous team. So this morning after the event, of course, as always, we're going to ask you for your feedback. And we're going to ask you to complete a survey on the event. Now, the last event that we had, we offered a Take a Lot voucher, and someone got a Take a Lot voucher, and that was quite exciting. This morning's event, we're going to do a lucky draw from everyone that completed the survey this morning on the event, and that person will win a free ticket to the conference at the end of September. Now, your 1 minute to complete that survey, you might see that free ticket, which is so exciting. So this morning, I'm going to now hand over to Chris Brits. Chris, where are you? Are you with us, Chris? There you are. Hi, Chris. How are you?
I'm great, Joel. How are you keeping?
I'm very, very good, Chris. Very, very good. Huge topic this morning. Chris, you and I, we've been talking about this intensely, obviously trying to look at what we're going to do on the landscape for the last couple of months. Chris, I mean, it's just so important that we evolve with the topic now and ensure that people's needs are being met.
Yeah, I'm super excited about this topic. It's something that I think we've been talking about at IMSA for many years. And whilst the framework encompasses ERM with its constituent components, this is one very crucial component of that framework. And as you know, I've been in the operational risk space for the better part of 30 years, and it's something that's very close to my heart. There are so many things happening in the market at the moment. It's crazy if you're in the space of operational risk. So just in very short, I mean, in the last couple of months, we've seen changes to the SANS codes, SANS 10400, SANS 10287. There's new economics regulations coming out the 1st of July. We've got POPI, the 1st of July. We are looking at new fire protection standards coming out of the industry. Currently working with SAIA and FIA. There's a very interesting initiative with the Engineering Council of South Africa, where we're looking at new ways of categorizing fire protection experts in the industry. There's just so much happening in this space. And I'm hoping this morning our panelists can debug some of the myths between operational risk and insurance. It's been something that's been lacking for a while, this conversation.
Oh, fantastic, Chris. Well, thank you. And I know that you will add so much value to the speakers as well this morning. So thank you for being here. And I'm going to hand over to you. Have fun, Chris. I think it's such an exciting conversation this morning. So I'm going to hand over to you. Thanks, Chris.
Appreciate it. Thank you, Joel. Good morning, everyone. So Joel's made my life really easy. She's done all the intros and already mentioned who all the speakers will be this morning. I think just to let you know, the format of this morning, we've got 4 presentations, and those will take approximately 25 minutes each. There is the chat where you can post your questions and also the Q&A. So please feel free to use those platforms. Jules already told you what the hashtag is to be on social media. In case you didn't hear it, it's hashtag live with IRMSA, and you can also post your thoughts and ideas there. So we are already 5 minutes late into our introduction, so I'm going to stop right there and introduce our first 2 speakers. So this is our sponsor, Marsh, and Marsh are representing themselves through Jane March, which is the MD of Placement, and Jane's got 35 years insurance experience. She joined Marsh mining team to handle major multinational accounts. Jane was also the mining practice leader before heading up the risk management practice in Sandton, and she was appointed as the national broking leader in June 2016. Jane will be supported with Tarashni Pillay, and Tarashni is the practice leader for property risk consulting at Marsh. Tarashni is the head of property risk consulting for Africa, the world's largest insurance broker with Marsh. Tarashni leads the PRC business, focusing on key strategic growth, financial, operational, and market initiatives. So without any further ado, welcome to you, Jane and Tarashni, and we look forward to you sharing your thoughts and ideas with us.
Thanks, Chris, and good morning, everybody. I'm just going to share my screen. Let me just see that we can do that. Can you all see that now, Chris? Are you okay there?
Yes, it's up on the screen. Thanks,
super.
Jane.
Thank you. It's been great. It's been quite upbeat so far. I will try not to put a dampener on it, given my topic, presenting on the insurance market. I know you're all living it. I certainly am. It's a very interesting space at the moment. So I'm just going to cover the global market because the markets are interlinked. Drill down a bit into the SA market, specifically on property and casualty, how to achieve a successful renewal. You know, we used to measure it on getting reductions, how much do we manage to get? Now we actually measure it on, is the client placed, do they have insurance sometimes? And it has shifted quite a bit. And then just where you can get some additional information. So yeah, it's a bit of what happened. You know, we were all going along quite nicely. And suddenly everything shifted. So if we look at the global market, this is the Marsh Global Insurance Market Index. We track rates for all renewals globally. I'll be honest, South Africa does not form part of the actual tracking of the data at the moment. We are joining probably from October this year, but we're pretty much tracking the global market. So if we look overall, this is all lines that we track and everywhere. The Q1 price increases were 18% on average. Now, averages are very, very average. You will see much more than this in certain occupancies and some renewals going home pretty much flat. So 18% is significant and it's not good news, but the good news is the Q4 of 2020, we were seeing average increases of 22%. So we are seeing a slight shift. Things are starting to flatten out internationally. I think it'll be a long time before we go back here where the nice blue, I took over my placement role in 2016, I was offered the position. I think my boss knew something I didn't, because this was pretty nice. And then interestingly enough, in terms of, we know it's a market cycle, but you know what, after pretty much 15 years of a soft market, did we really think that the market was going to change like this? Or I can remember having conversations, is anything actually going to shift it? Well, yes, it did. And normally from a South African perspective, we follow the market. We're normally about 6 to 12 months behind market cycles. But interestingly enough, 2017 was a really tough year for the South African market. We saw the Knysna fires, we saw the big loss in Durban, the warehouse, plus a number of others. So for the first time, South Africa was actually ahead of the global curve. I'm not going to drill too much down into the regions. You can see UK's leading as one of them. So yeah, there's a little bit of good news coming back and a little bit of stabilizing. So just drilling down a bit more into property and casualty, good news is the property has reduced slightly more. We're looking at 15% on average increases. However, where we see the problems are some of your big ugly risks, you know, where you need a lot of capacity, you're going into the market, and often what we see, and you've probably experienced, is you can get a placement 70% home, 80% home, and then just the others who are not really interested have given you a walk away price. And if you can't fill that capacity, you actually have to use them. So that can often drive the price higher. I will just make a comment now on South Africa specifically. Globally, the smaller and domestic accounts generally experience more contained increases. We do see some challenges in some of the difficult risk occupancies in that mid-tier space, and I'll talk a little bit more about that from a South African perspective. Insurers are cautious. They are restricting the capacity they're deploying. I think you've all probably been involved requesting more information, you know, limits, exclusions, where people had infectious diseases. Obviously, that's gone. Now all non-damage BI markets are looking to limit. So we're getting less cover for more money, basically. We are starting to see a little bit of flexibility and openness to new business. I think in South Africa, and I know we'll talk a little bit more about it, it is very risk specific. If you need sprinklers and you don't have them, most markets, while your existing market may work with you, a lot of the markets just don't want to look at the business. We are seeing that this bottoming out or flattening out a bit is being driven. We are seeing new capital coming into the market and new carriers. So whilst nobody is coming in to carve up the market, you know, new capacity coming in always sort of levels things out a bit and helps to contain the increases. Casualties, the other line, while the rates aren't as significantly high, we are still seeing challenges here. Large US has always been an issue in terms of casualty, which remains that if you've got US exposure, it is a different risk. Locally, in some markets, there's still competition. I think the UK market, whom we access, Lloyd's market, for quite a lot of capacity from a South African perspective, is tightening up. I think South African risks have lost the flavor a bit. They're not as nicely viewed in the international market as they used to be. And then coverage restrictions. Also, we are seeing major coverage restrictions coming in here. In a soft market, brokers tend to get all the coverage included, all your nice to have, incidental medical malpractice, products guarantee, products recall up to a certain amount. All of that is now being retracted and saying we need to take that out. And you need to underwrite it separately. And obviously then you've got a separate program and the pricing goes up. Just moving on to some of the other even more challenging lines, your financial lines. And I'm going to focus here on cyber and directors and officers liability, because, you know, I think while property tends to be your biggest premium spend, the rates and the increases and the restrictions we're seeing in these two spaces are even worse. I mean, you can look at Q4 2020, average increases were 47%. Q1 2020, it is flattening out a bit. 40%, but I mean, it's quite scary. We're sitting here, who'd have thought in 2017 we'd be saying, okay, well, prices are bottoming out. It's starting at, we're looking at 40% increases, but we are where we are. Very stringent underwriting guidelines, reduction in capacity, the risk selection is key. Distressed sectors in D&O, from our perspective, we're seeing pharma, mining, financial services, and medical are our main challenging classes there. And it is very difficult. We are seeing clients reduce limits because either the limits are just not available anymore, or they are just so expensive. Clients are deciding to actually reduce the cover that they've got. Some financial situation, COVID hasn't happened, so insurers are being very cautious there. And then, we have seen some clients actually saying, you know what, we're actually not going to buy insurance here. So that is a significant shift, and I'm not sure if anyone would like to be on one of those boards, but that we'll see what happens there. So cyber is the other one. I mean, we've seen major ransomware events, and we are seeing them in South Africa as well. I think the cyber market was a relatively new market. There wasn't historical data. Markets came in, they saw premium growth. Now the claims are coming, and we are seeing co-insurance is required for ransomware if you can get the cover. Insurers are scaling back their capacity quite significantly. And there's just deductibles, limits. It's just probably one of the hardest hit classes because it's new, historical data wasn't available, and now we're seeing the claims. It is affecting all industries, but healthcare and manufacturing, and some public entities, they're the worst. But I mean, any of you who do buy cyber will be seeing what's happening here. So it is a very challenging area at the moment. I'm just going to drill down a little bit into the South African market, as I said. So we are tracking global averages in terms of price increases, but it is very risk dependent. We have some renewals that are going almost flat. Others, you're really struggling to get 100% capacity. High hazard occupancies are the worst. Cold storage is virtually a swear word in the international market, driven by claims and fires and the potential for loss. Woodworking, a lot of heavy manufacturing, textile risks, especially if these risks are, I'm going to say, inadequately protected from an insurer point of view, and if there's insufficient evidence of traction on risk improvement. So what we're seeing is the risk attitude of a client is key. If you're not interested in your risk, you're in a hazardous occupancy, it's not well protected, the insurance market's not going to be interested in underwriting your risk. And we've had good traction. What happens in the soft market, and unfortunately, there's not a lot of regulatory monitoring in terms of are the risks adequately protected from a fire perspective. Yes, the human element they look at, but the insurers are almost driving what should be there anyway. And they're not expecting everything to be done, but we've had a few years of this in a soft market and a constrained economic environment. People haven't invested in risk protection. The insurers never required it. If insurer A asked some questions, you could go to insurer B or C or D. Everyone was looking for growth. Now, nobody is writing premium for growth now. They are underwriting. Insurers are actually underwriting again. They are underwriting risk. So the risk attitude is key, your traction on risk recommendations, and insurers are open to discussion. They are not open to just say, I'm not going to do it. We are seeing very onerous conditions, especially where items haven't been actioned, or we've said they're going to be actioned and they've been kicked down the road. You could end up without fire cover or a significant co-insurance. So it is how you manage your risk, how you're investing in your risk is what will get you the best result in the current market. And yes, we do have appetite for international markets for South African business. It's not as so prior to 2017, international insurers like South African business. It's not as nicely viewed at the moment. And again, risk quality remains key. If one insurer doesn't like the risk for specific reasons, those reasons aren't going to change even if you go into the international market. And as I said, some of the sort of smaller risks, but that are high hazard, not adequately protected, that's where we are seeing a lot of challenges in terms of getting the markets to write those risks. International market, you end up with minimum premiums, so it's not always a solution. So that's where we're seeing a lot of issues now in terms of getting those placed. In South Africa, we've said we've got new capacity coming in globally, and we've got a little bit trickling into this market, especially on the reinsurance side and some facultative reinsurance. So those green shoots are starting to appear. We've still got a bit of time, I think, before we see any significant shift, but it's a marketplace, it's supply and demand. So if we've got a little bit more capacity than we need, then we can start discussing price and restrictions. Just in terms of COVID, just a brief update here. The South African Supreme Court was one of the first internationally to rule largely in favor of clients on COVID losses in the lockdown. There was always the issue, can you separate lockdown from COVID? Our courts cleared that up. So for clients who had infectious disease cover, claims are now being quantified and settled. So the overall market approach, let's get the small ones out the way quickly, and then we'll adjust the bigger ones. So I think while it was very tense while we were going through these court cases, and I think the industry came under a lot of criticism, now that these have been decided, insurers are honoring it and are doing really well in terms of the settlements. We saw in Q1 this year on the bigger losses, obviously you've got normally on a 12-month indemnity period, sometimes longer. It's the loss over the period. So, are you going to make it up? Is it a total loss? So that's why some of these claims have taken longer to settle. Some clients have experienced spikes in revenue or savings have come off. So the claims haven't been as bad as as high as we've initially thought. We have seen some quite interesting interpretations of policies and sublimits. So it's just working through those. And the interesting thing from a reinsurance space is that reinsurers seem to be adopting a payback approach, which is quite strange. The losses, the premiums of the many pay for the losses of the few. This reinsurer is almost saying, well, whatever your COVID losses are, I want it back in X period, which to me is more of a spread loss facility, but we'll see where that lands in the reinsurance market. But I think it's going to overlay another layer of complexity. Once these losses are all quantified and settled, it's going to put further pressure on the market. So we'll just have to see, increases to pay back the COVID losses versus new capacity coming into the market. We'll just have to see how that goes. From a casualty perspective, our market is hardening. Increases aren't as severe as property, but we are seeing the main focus is reducing coverage. I mentioned those specialist lines of coverage that were thrown in the soft market. Very cautious on capacity they're deploying. We are seeing significant reductions. Sometimes people are halving the capacity they've put on the risk. We do still have capacity locally, so it is giving clients options. But where you've got big limits, we are having to go into the international markets, and that's where we are seeing the biggest increases coming through. And also restrictions, contaminated products, for example, some niche standalone coverages are being very difficult. Markets are just not interested in writing them, and then we're having to go into the international market. So what do we do as risk managers? How do you achieve a successful renewal? And definition of success, I say, has shifted somewhat. You need someone partnering with you. Seek professional advice. If you're in the market every day, we know which insurers we can go to for which risks. It is very risk dependent. It's very industry dependent. So get someone to partner with you who knows the market. And this is the biggest thing. I say it within Marsh. I think everyone's tired of me saying it. Allow yourselves time. Engage as early as possible. you know, plan ahead. Things go wrong. You think a market, and we've had it, the market says, yes, we're fine. Oops, sorry, no, we can't write it. Or, you know, a couple of players, if you've got a co-insurance basis, lose 10 or 20%, suddenly you 40% you've got to find in a hard market. So engage and plan and allow time. You know, you're not going to get the terms you want on day one when you get your first results back from the market. You need time to engage and push back and look at alternatives. Quality of underwriting information is critical, as I've said, especially around risk mitigation and protection. The more you can sell your risk, the more you can focus on it. And yes, we like to present company financials and general information, but if you hit those key issues that the markets are looking for, what I've done on my risk, how I've improved it, yes, I've still got issues, but this is what I'm doing about it, that's going to achieve, you're going to get the market's attention, and that's how you're going to get a better result out of the current market. And I think you've all seen it. Expects results, requests for additional information. Yes, underwriters are underwriting again, and brokers are having to broker again. You know, anyone can broker in a soft market. A hard market, you've got to be a lot more strategic, engage with insurers. And I think you've all seen that. Proposal forms, information, you give information, there's questions. It's worth it to get the better result. We advocate strongly, present to your insurers, market your risk. You need to differentiate your risk. Yes, I'm in cold storage, but why should you write my risk versus everyone else's? No one's, as I said, no one's looking for premium growth. So you've got to make them interested in your risk and want to write your risk. From an internal perspective, manage expectations. No one likes surprises. Let's have open conversations. You are facing increases. Restrictions in coverage, but it's easier to have those conversations early, manage expectations, and then try and achieve a better result than the surprise right at the end where, oops, actually we're not placed, or we've got issues, or the premium's gone up. So it's very important. Communication along the way is very important. The other issue is subjectivities, you know, and this comes around to starting early as possible. We can have pages of subjectivities from each insurer. So if you've got 10 or 20 insurers on your risk, you've got a whole pile of subjectivities. Everyone wants this clause for their risk. Somebody else wants the same sort of thing, but with a different wording. So it takes time to either get alignment or to negotiate those out. And sometimes it is around subject to certain information being received or things being complied with. So start early, give the information, market your risk, and check what you're getting. I mean, that's my message there. So I hope I haven't depressed you all too much. If you would like additional information, we do have our first regional market report, which we've published, includes updates on COVID and everything. So yes, there's the link if you'd like to do it, or you can email us at Marsh to get a copy of this report. So that's it from me for now. Chris, back to you, and then over to Tarashni. Thank you.
Good, Jane. Thank you for sharing those insights with us. It's a little bit depressing, I suppose, looking at what's happened to the market. They obviously had a lot of faith in you taking that role on 3 years ago when everything tanked. I think the question I have is, what is the outlook for South Africa going forward? So we've had over the years, you know, the 7-year cycle that we become quite familiar with. This one seems a bit different. So in your opinion, what does the outlook look like over the next 2 to 3 years in terms of property and where we see premiums going? Will we ever normalize to where we were before, or is it going to be something quite different?
I think if you look at it and you look at the market cycles, yes, people spoke about 7-year cycles, and it's around, and I know Tarashi's going to go, it's around profitability, you know, then you look for growth, and then you start competing, standards slip, premiums drop. And it's always, I think, everyone talks about a market cycle and shows a wheel. It's not like that. You get a gradual softening and you get a knee-jerk reaction. The market just almost seems to change overnight. So I think because the soft market was with us for so long, and yes, we had blips in mining and a couple of other industries over the time, but they were literally a year and things were back to, shall we say, normal. I think because it's been such a long time, I think we're going to see a longer recovery. And if you track your rates over the last 10 years, where were you and how much have you gone back to? You're definitely not back to where you were 20 years ago in terms of rating, probably. So I don't think things are going to shift significantly. I hope there will be a stabilizing of capacity, so insurers won't continue reducing. We are, as I say, seeing some new capacity coming into the market internationally. So that is your first sign of a stabilizing, and I'm not going to say softening market. Whether the market will ever go back in terms of risk management, I'm not sure they will. I think the pressure on risk management will remain for quite a long time, and especially in hazardous occupancies. That has slipped a lot. Some clients, yes, did carry on doing it because it's the right thing to do. That's the way they manage the business. Others, if you don't have money, if the business is, constrained, we're not seeing the economic growth, it's very difficult to invest in that. So it's a balancing act, but I'm not sure we will go back to a soft market without any form of risk control being required. But I'm hoping in the next probably 2 years, maybe in a year, we should see some stabilization. And then if that new capacity starts coming into the market, we should see some softening.
Thank you. So the message I'm getting is get your house in order, make sure that your risk controls in place, make sure that your policies and procedures are fully embedded into the business, and you will be rewarded over the long run for good behavior.
Yes, absolutely. Agree.
Okay.
In a nutshell.
Right. Jane, I have one last question that's quickly come through. I have a couple towards the end in the panel discussion, but the question from the listener was, are there any new innovative risk finance solutions coming through for clients where they can't find capacity in the market?
Yes, there are. I mean, it depends on what you're looking for. You can either sort of look at as I said, a spread loss. If you're finding, and it's always difficult at the lower end, and I'm going to say deductibles increasing or risk retentions increasing, there are ways of financing that over a period. Spread losses are coming back in. The other thing to look at is your parametric type insurances. So there's a trigger, and it's not, if the trigger happens, you meet certain criteria, an amount is paid. It's not, well, here's the conditions of the policy, we need to see this, we need to see that. Now, it works well in certain instances, but if you look at what we're seeing in terms of the rates for those versus your overall insurance rate, the risk transfer piece is probably still and I'm going to say in the short term, the cheaper route to go. It depends on what you're looking at, but those options are coming back in. They are very much written on a bespoke basis and working with clients, and they are quite long lead times, but they are available. But risk transfer, what you pay on that for certain, I'm going to call them perils versus your overall risk transfer. Yeah, I think you're doing it to do it differently and for a longer term approach versus trying to save money in the short term.
Great, thank you. So I think the message to the audience is if you're not getting, somebody talking to you about other options, speak to your broker, speak to the person. There are things out there that can be done about the fact that you might not find capacity, that the rates might just be beyond reach. There are other alternatives and things that you could be considering. Great. Thank you, Jane. We have kind of gotten a little bit over time. So Tarashni, I'll ask you, please, as soon as you're ready, please share your thoughts with us.
Great. Maybe just give me an indication of whether you can see my presentation.
We can see the screen. We can see all the slides. Perhaps if you just, there we go.
Right. So thank you. Good morning, everyone. We've just heard Jane, speak about the hard insurance market, and it's really clear that what the space looks like. So, briefly today, we'll go through the hard insurance market. really how are insurers evaluating operational risk and the role that operational risk plays in the insurance market, and then how operational risk can be used for the betterment of your insurance placement. What this slide shows here is, sorry, I seem to be having some technical difficulty. Chris, I'm not sure if it's showing in a full view. I'm unable to get it from my side.
No, it's not. It's showing.
Yeah, great. If we could have someone from the OMSA team put up the presentation.
Sure.
Thank you.
Roxanne, can you assist us to put up Tarashni's presentation?
Perfect, Chris, will do.
Thank you.
While we wait for Tarashni's presentation to come up, I am seeing some questions come through on the chat line, and I've also seen some on the Q&A. So please continue to send those through, and where we find time, we'll pose those questions.
Are you able to see the presentation, Tarashni?
Yes, I am. Thank you.
Perfect. You can just cue me and I'll navigate for you.
Right. I fear you may have a really old one up there. Let me try again from my side. All right, it seems to be stuck on this side, but I think I'll talk to it from this way. So, earlier we heard my colleague Jane speaking about the state of the insurance market, and I think it's clear from what she had to say that we find ourselves in an environment where the market is hardening. I think what this infographic here, and apologies that it's so small, really does is it describes all the factors that contribute to the making of a hard market. And I think what we can see here is that it's quite a complicated picture. There's a lot of interconnectivity, there's a lot of moving parts, and really COVID hasn't helped those pictures for all seeking a business insurance placement, particularly in the property and casualty segment, like Jane's mentioned earlier. And I think, as Jane said, as a result of COVID, insurers now find themselves in a low interest rate business environment, where interest rates are likely to be low for a really long time. And they've really had to shift their focus and their strategy from their underwriting margin towards their underwriting margin and operation results. And this means, as Jane has mentioned before, that their risk selection and their risk appetite really now favors those organizations where superior risk and particularly operational risk management is present. And I think, this is very important in terms of your renewal, and Jane has stressed this before. So if we move to the next slide, you'll see it's important to see, to note that, and Jane's mentioned it before, Chris has highlighted it and others, that the hard market is cyclical. We expect this of the insurance industry. I think the only difference between the hard cycle that we're currently experiencing and previous cycles is that the end was always relatively in sight. You can see here from the infographic, 6 to 12 months, the longest cycle being in the 80s. For 3 years due to that Black Swan global energy crisis event. But with COVID here, we aren't really sure how long we're going to be in this state. And so OpRisk is really the focus here. I think what we have seen though throughout all of these cycles, the one constant that has been there is that organizations with superior OpRisk reduction strategies, speaking to how you're handling physical risks, how you're handling to business reduction, business interruption reductions, has always fared much better in terms of those, lesser reduction strategies in terms of placement. And James mentioned before, particularly those policies identified as high hazard occupancies, textile factories, the swear word, cold storage, manufacturing facilities, energy. It's really important that now we understand how insurers are using operational risk management as an indication for exposure for better placement. And if we move to the next slide, I think what we've noticed is that for many, it hasn't been obvious how heavily weighted operational risk is in effective business insurance placement. So on the next slide, please, we'll see that it's often not well understood that there is OpRisk is a significant factor that can move, your premium up or down and determine your premium quite significantly. So what we illustrate here is where insurers are understanding and looking and evaluating operational risk management in their decision-making process and how they use it as an indication of exposure. And we can see that it's used from the very start of the policy process right up until the end. It's first used at the underwriting stage to see if it meets the insurer's risk appetite, if it meets their hazard classification, and then in determining terms, rates, deductibles, guarantees, warranties. At both of these two initial stages, there really is an in-depth evaluation of a business's operational risk reduction strategy. And, it's taken into the stages of capacity determination. And it may be interesting to know that it's also used at the claims assessment stage, what insurers are able to use as a proxy for determining whether OpRisk is really well managed or not is your claims and your loss history. Have you had a fire event, as Jane was speaking about? Have you had a supply chain disruption claim? Has there been a cyber incident? And in capacity determination and in understanding that OpRisk, really understanding how much of that risk they'd like to insure, whether they can transfer it, and whether they would like to retain it. Jane and others spoke about risk financing options and international placing options. But, really importantly, OpRisk is used for renewal terms, and Jane spoke about that as well earlier. So we can see that it's quite important. And if OpRisk and OpRisk reduction strategy is quite deteriorating, it really impacts your insurance and your placement process. But you may also be in a space where before renewal terms, insurers are looking at this, they're evaluating it, and they may choose to cancel your policy. And so I think the next question that we should answer, now that we understand where it fits into the insurance process, how it's being used, how it's being evaluated, is what type of OpRisk are they concentrating on? What type of OpRisk is being focused on by the insurance company, and how are they doing that? So the next slide shows you this. So if you've ever looked for business insurance on the property and casualty side, you would have no doubt interacted with a risk engineer at one point in time. And, risk engineering or risk management tools, on the next slide, please, are really the insurer's primary means of collecting operational risk information. I think operational risk management information usually related to the risk classes of business disruption or physical risks are really concentrated on. And I've listed some of them here, some of those OpRisks that are focused on quite intensively by risk engineers when they come out to your premises. Chris Bristow knows a lot about this. What you see is that fire and explosion is really one of the biggest proxies for business interruption and physical risk. And it's really been heavily focused on. But as the risk environment changes, as the landscape changes, as we see new and emerging risks come up, we see a lot of focus on environmental risks, on external fraud like cyber, product liability that Jane spoke to earlier. And we also see, a lot of natural disasters. You see a lot of natural disasters being, the focus of why some of the market is hardened, and a lot of evaluation going around there. And more specifically, vandalism and terrorism. And if we go to the next slide, please, what it shows is how insurers are collecting the information that the previous slide focuses on and how they're ingesting it to determine premium, to determine whether there's good operational risk management, and to see whether there is improvement, as Jane spoke about earlier. And really, it starts with collecting qualitative information, where we have we use a risk rating and a ranking approach, really uncovering a lot of what the physical risks and the business risks are, looking at things like construction. What are the occupancy hazards available that are in the business? How are those being mitigated? How are those being controlled? What policies and procedures map to them? What sort of physical protection do you have in terms of fire? And what are your exposures? Are you aware of what your neighbors are doing? Are you aware of how that exposure is compromising your business? What are you doing to mitigate that? Do you have a holistic, integrated view, multi-lensed view of your risk, and how is that all coming together? And this is really the depth that insurers are going through to understand what your risk looks like and what the risk around you looks like and quantifying it. A hot topic there is fire protection, especially when you have a high hazard occupancy, as we've seen before. And, that's a report that they called a COPE, and that's really where risk managers, the risk management function, risk reporting is super important and is becoming more important as we move further and further into this hard market. That information is digested qualitatively and quantitatively expressed in a report called the loss estimate to insurers. And this really moves the dial in terms of how insurers place capacity in, and what your exposures look like from a financial point of view. And here engineers will use what's called a best case or a worst case scenario analysis, and really trying to quantify what the exposures were being. So if you have a X amount type of risk, what would the impact be upstream? What is it downstream? How does it affect the business? How does it affect the value chain? And ultimately, what is the exposure sitting with the insurer? And then finally, a risk engineer will produce a risk engineering report. And this really is the basis for a successful renewal, as Jane said. When these are identified, what is the plan to mitigate the risk? How are you going to do it? Can you carry through on it? What is the spread of policy and procedure risk improvement recommendations versus physical risk improvement recommendations? If there are things that reflect risk management interests that are easily, you can be easily mitigated or can be easily implemented, those are the quick wins that one can do to increase their insurance placement by making sure that those are done and putting in plans or CapEx plans for more of the physical risk improvements. So if we move to the next slide, really what we'll see is how do we actually use how do we actually use risk management? What are insurers concerned about? And this is not a pretty picture. So we see here that insurers are concerned about supply chain risks at the bottom. They're concerned about massive fires. Jane spoke about some of those happening in the industry in 2017. And really what we need to be considering is that, operational risk management, yes, improves insurance placement, but it goes beyond that. This is about protecting the going concern of society, the economy, and the environment. Many of these losses, unless you're a huge corporate or a global entity, are unsustainable for most businesses. And, the financial impact of fire losses, of business interruption losses from a property and casualty perspective is 0.69% of gross national income. That's billions of rands lost from the economy because of a lack of control around operational risk improvement. And we can understand now why insurers are so interested in this. And, finally, if we move to the next slide, this slide really just shows how do we manage OpRisk for better insurance placement. And the goal is to use operational risk to not only lower your risk and improve your risk quality profile for insurers, but for yourselves and your own going concern. But it really goes around protecting and understanding what are your risks. Do you have partners who can support you in managing your risk? Have you revised operational risk policies and procedures? And are they improved? Is there continuous monitoring? Have they been implemented? Are you meeting risk KPIs? Do we understand what the business risk is? So implementing business interruption risk controls, performing business impact assessments, refreshing them every year as new risks come into the business, as new risks emerge in the landscape, and then completing insurer risk improvement recommendations, really to show that there's been improvement in your business profile. And then upholding risk management interest and risk culture. This is really, this is sort of a subjective rating that's become really important in insurers' rating engines that actually influence your premium quite significantly. So very important to show that there has been a risk management culture and policies. And that really is the story to supplement, the hard market and understanding how OpRisk fits into insurance, how it can be managed for better insurance placement. And often, having a risk management partner here with the risk engineering expertise who understands operational risk improvement requirements from an insurer perspective will probably be very valuable in helping you navigate this market. Thanks, Chris. Hopefully I made up some time there. But that's the operational risk story for insurance.
Great, thanks, Tarashni. It's been interesting to go through the slides with you. I've just got 2 questions, and we are short on time, so if we can just keep them as brief as possible. So one of the questions coming through is when somebody goes to see a client and they sit down and talk to the client about their risk management program, the client says, "But I'm complying with all the statutory requirements." And what the clients tend to find challenging is, can you explain to the audience the difference between statutory requirements and insurer requirements?
Yes, so insurers are governed by their own internal underwriting technical guidelines and procedures and their own views of what risks should look like and what standards should be complied with. And often what we find, particularly in the South African context, and particularly when engaging with multinational insurers, is that some South African codes, some South African practices are relatively not refreshed or updated when it comes to what technical guidelines underwriting procedures have been based on. So, what we do have to understand is that risk is changing. We're in a landscape where materials are changing. Plastic, how, the components of plastic are changing, the components of our building material is changing, and our codes are not keeping pace with those. And this is where the difference is coming in between how underwriters are viewing compliance with local codes and with their technical guidelines. And, evaluations and independent evaluations of that are of their risk and of the codes and of what protection measures are there and of how the building is being protected is really being tailor-made for the risk itself. Yes, you're in a building with a sprinkler system. Yes, it's been designed to SANS, but is the sprinkler system protecting what you are actually doing? You're a biodiesel factory with a library sprinkler system. There's a mismatch there. And so underwriters are recalibrating for that. It's no longer sufficient just to comply. You have to comply for the efficient risk management of your actual operation or building risk.
Thank you. So if I'm understanding you correctly, some advice to the client is when you're engaging in a change in operation, when you're looking at adding something, putting up a new facility, changing your processes, it's critically important to engage with your broker and your risk engineering team as well.
That's 100% correct. A risk engineering partner can advise you on what are insurer requirements, where is the gap between what you actually have and what is needed, and then support you through the process of implementing and controlling any risks that may result of that change.
Thank you. The last question I have very quickly is, in an insurer's opinion, what is an adequate risk management program look like?
So an adequate risk management program is one that looks at, really evaluates what is the risk that is present at the business, what measures and controls have been placed to understand the risk, to identify the gaps, to fill those gaps, and then what monitors, controls, and KPIs are put in place to make sure that there's no degradation of the risk and that it's still fully understood and that it's still being complied with. I think it's really important that we understand that process and that's how insurers are viewing it.
Good. Tarashni, thank you very much for your insights. We appreciate your time this morning. So before we move over to our next speaker, who's Thokozile Mkhangu, we have a short video to play for you.
A global leader in insurance broking and innovative risk solutions. Marsh provides personal and business insurance solutions to protect our clients' businesses for future growth while offering lasting peace of mind.
Good. Thank you very much for that, and thank you to our sponsor, Marsh. So we now move on to our next speaker, and we are running slightly behind schedule, so we apologize for that. Thokozile Mhlanga is our next speaker and has 19 years experience with the short-term insurance market, with experience in claims management, underwriting, sales, marketing, and communications, and drafting contracts. One of her key strengths in business growth and nurturing developments of skills in others. This strength is reflected in her transformational leadership qualities, and Thokozile was an executive manager at Sasria for 10 years. She's a member of the Fire Protection Association Board of Directors and is the Audit, Risk and Compliance Board Committee Chairperson at the Fire and Protection Association. She previously served as the head of the educational portfolio at the Insurance Institute of Gauteng before being nominated as a vice president in 2016. In 2017, she was nominated as the deputy president of the same organization. So I welcome you, Thokozile, onto the stage. And we've obviously heard what Jane and Tarashni have had to say. We look forward to your perspective on the topic. Thank you very much.
Thank you, Chris. Let me just share my very short presentation. You'll let me know as soon as it's showing on your side. Oh, good.
Yeah, it's good. If you just put it into presentation mode.
Yep.
Thank you. You're good to go.
Thank you. Good morning, ladies and gentlemen, and thank you for the warm welcome, Chris. This morning, I'm going to talk about notable trends that have emerged in the last year, 12 months or so. A lot has happened and a lot is happening in our world that is shaping how we do business, shaping how we relate, and how we do life. I've picked 7 trends. There's a lot. So I've picked 7 trends for today's discussion. I'd like to kick off by asking each of us to just rate the 7 trends that I have according to priority or impact on organizations and your views. There's no right or wrong answer. And Roxanne, can you just show that up? Thank you. I'll just give it a few seconds or a minute. Roxanne, I'll be guided by you on the responses. Interesting. So the top 3 is digital transformation, number 1, and get a bit of a tie with the need for innovation, building resilience, and optimizing the use of data. Thank you. That's quite interesting. In today's discussion, I have not prioritized, I'm struggling to move to the next slide. I have not prioritized the 7 trends. So I'm just sharing them not in any order of priority. The first one being digital transformation. The journey to digital transformation is not new. We all know that. We've all started with digitizing for many years. However, the pandemic accelerated it. I believe all of us thought we had time, but life turned upside down last year, or maybe even going back towards the end of 2019. Businesses had to respond rapidly. Those that couldn't are struggling or possibly out of business already. There are various factors that will continue to reshape the digital transformation journey. And those factors range from customer needs to the need to be relevant, sustainability, to the strategic direction or positioning of organizations. I'm not going to go into a lot of detail on that, but I would rather move on to the second trend, which is the new customer. The need for customers has changed. The customers become a bit more demanding as we are aware. What we are also noting is that the customer is more connected and demanding instant responses. The customers are more alert, they are more knowledgeable, and they are more aware of what they're looking for. What we're also noting is that those that work in call center environments and making maybe hard calls or sales calls, customers are no longer receptive to that because they know what they want, and they know where to get it. So whatever they decide they would need, they go ahead and go look for it instead of being a push approach where a product is presented to them. This has brought opportunities for insurers to design products that are relevant, that are meaningful, that actually talk to the needs of the customer. It has also meant that there's a need to customize a product and customize the service as well. The question, however, is can we truly customize products and can we truly customize services? Can we truly meet the needs of the customer? That's a question that I'm asking myself and I'm putting forward to the delegates on, are we ready to do that? Do we have the resources to do that? Do we have the skills to do that? The other trend is the need for innovation. The customer needs and the need to digitize has opened an increased need to innovate. Innovation increases the chances to react to changes and opportunities. It requires flexibility. It requires not only thinking outside the box, it requires us to throw the box away. It requires reinvention of businesses. It requires reinvention of approaches of engagements, reinvention of stakeholder engagement and management. It requires a complete overhaul of businesses. And that's not just a simple and easy way of amending processes and procedures or enhancing our systems. It really requires a deep dive into, are we doing business the way that is relevant? Are we doing business the way that is going to take us into the future? The second trend is agile working. All of us have had to quickly learn to work remotely. So agile working is about bringing people, processes, technologies, and connectivity, time and place all together into one without the limit of structure. It goes beyond flexibility. However, it comes with the risk of losing the human touch. What we are seeing is organizations struggling to keep the workplace climate and the human touch and the human connectivity in good order. There's also an increase and a rise in mental health cases and the impact of productivity and customer service with all that. We know the challenges of remote work and connectivity, depending on where you stay, becomes an issue. And then, of course, load shedding doesn't help. It also impacts that the cost of data, because then employees need to be reachable and accessible at all times. It meets the needs of the customer because you are available at any point. You are available pretty much all the time, but it does come with the challenge of the impact on productivity. And the loss of human touch is one of the challenges that we are seeing organizations struggling with. We are social beings. We are meant to interact with each other. And this type of interaction that we're doing today, for example, is what we've had to adjust to. It's been something we do once in a while. Now it's become the order of the day. That's just how we relate. I'm also even seeing coffee sessions happening over these type of platforms. We are meant to have the human touch, and that has got a big impact on human beings as a whole, and that does affect the productivity, as I highlighted, and the need for human capital to be looked after. The fifth trend is building resilience. We are seeing organizations adapting and repositioning themselves to respond to adversity and the challenges that they are faced with. And there's also a need to improve the relevance of businesses, the retention, investment in the wellness of human capital. There's also a focus in protecting the balance sheet and also making sure that there's social relevance. So the need to build the resilience is really becoming elevated and relevant, because there is so much that organizations have to respond to. The challenge or the journey of digital transformation does require that we build resilience internally to be able to take that forward. The demands of the customers does mean that we need to relook at the skills we have and build that resilience, and making sure that we keep moving forward, we keep journeying with the customer, and also making sure that the balance sheet is protected. The sixth trend is optimization of data. There's always been a lot of data that insurers and intermediaries have access to, but not much was being done about it. What we're seeing now is that organizations are beginning to utilize the data effectively. They're beginning to utilize the data to understand the customer behavior, the consumption behavior, the engagement behavior, the preferred method of communicating with the customer. That is making sure that then organizations design relevant products, organizations design relevant solutions for customers. We're seeing a lot of intermediaries and insurers really becoming top-notch when it comes to engagement with customers, and engaging with customers at the right time, making sure that the customers are locked in and not losing the customers. So the data that companies have access to has become actually a valuable asset. And yes, the ladies spoke earlier about the risk, the cyber risk. It does come with its own challenges, but what we are seeing is that data is really now taken to another level, where companies are now looking at, this is what we now have. How do we respond? How do we design solutions that will take not only organizations forward, but will take the industry to another level? The last trend is the future skills. I'm sure you've read many reports on this and have attended many sessions on this talk, and it has become elevated. There's been a report by McKinsey that highlighted that repetitive functions will be replaced by robots or machines in the near future. And what we are seeing is that the move towards that replacement is there. There's a lot of functions that no longer have the human touch. If you are like me, I still prefer a human being. I still get frustrated talking to a robot, typing, and it gives you the same response. Hello, I am whoever. I have been trained to help you. I'm still one of those behind people, but that's where organizations are moving to. And there's a positive to it. You can then start utilizing your human capital in areas that are relevant. It does come with upskilling or reskilling. It gives people an opportunity to elevate their skills. It gives people an opportunity to reposition themselves in the corporate environment, and gaining skills that ordinarily they wouldn't acquire. It does come with risks, and the risk of uncertainty, the risk of job security, the risk of upskilling as well. Then not everyone is comfortable to be upskilled. Not everyone is comfortable to be reskilled. Some people are comfortable doing what they have been doing for many years, but the environment has changed. So the future skills does mean that we really need to stay connected with the human capital, with our employees. We need to make sure that the risk of replacing certain functions is balanced with the importance and the investment in the human capital that we work with. So that uncertainty brings anxiety, which takes me back to the point I made earlier, the increase in mental health. So there's gotta be a balance of all these things that are happening around us. At the center of it all, there are human beings that have to experience this. There are human beings that have to adjust into this digital environment that we now work in. They're human beings that have to respond to the customer needs. They're human beings that have to really work in environments that are different, that we've all had to quickly learn overnight and just journey with it. And that does require a lot of sensitivity, a lot of connection or wisdom in staying connected with the human being and making sure that we journey and we move forward with them. All those risks, all those trends, all those challenges do present something to the industry. There's a need to better align risk management with what is happening around us. Operational risks such as product failures or gaps in products, loss of key personnel, or the issues of health and safety, IT-related risk, they all present opportunities to the industry. So they present opportunities, as I said, innovation-wise, throw the box away. Think freely. Think, how are we going to utilize all these things that are happening around us? How are we going to turn that and reinvent businesses? How are we going to redesign the products or enhance the products? How are we going to really utilize everything around us and take insurance to another level? So that is really what we are seeing in organizations, and not only within the insurance sector, but overall in the economy, in the country, and not just SA, in the globe. These are all trends that we are all struggling with and trying to figure solutions on how we go forward, how we move forward and turn things around. And also looking at the opportunities and the need to perhaps review our risk appetite and allow ourselves to take a bit more risks, and don't look at the conventional way of how we've been doing business, and also balance the element of protecting shareholder value against the element of meeting the needs of customers, journeying with the customer, and enhancing the digital transformation, but also open up a bit and review the risk appetite. So before I close, I'd like us to go to the poll again and see if our views are different after the content that I've just shared with you with regards to the impact of the trends that I've highlighted this morning. So thank you, Roxanne. We'll open the poll one more time, and just to check is it any different now? I'll be guided by you, Roxanne.
Dr. Zila, thank you very much. That was most informative, and I think it made a lot of people sit up and think about their businesses. We've seen the results come through. Maybe you want to make a comment on that.
Yes. So in closing, it's interesting how now it's changed. While digital transformation is still tops, building resilience, also their future skills, also there is definitely a need. It's clear that we need to stay connected. We need to continuously design solutions that talk to the environments we live in, building resilience, reinvent, reposition continuously. Thank you, Chris.
Good, thank you very much. That was, as I said, most informative. We've had a number of comments come through. And if you go onto the chat screen a little bit later, you'll see how many people have said thank you for the presentation and the information. There have been a couple of interesting questions. Just for the sake of time, I'll limit them to one or two. So thank you for staying on there for a second. The one comment, I'm not going to ask you to respond to this, but the one comment that's come through is, do the brokers and insurers really know their clients? And I think that's something we need to think about, because it's not often that you can sit with your broker or your insurer and they've taken the time to actually get to know your business and how it works, what you do, And I think that's something that makes us all think a little bit about how better we can interact with our clients going forward. They're not a number, they're special. But there has been one or two other questions. I'd like to pose them to you, please. So the one is, how has the IISA used these trends that you've identified to reshape or improve the industry that you're operating in?
Thank you. So we've taken it home and really applied it to our space and looked at our value proposition, both to professional members as well as to our corporate partners. And in reviewing the value proposition, we went back to the industry and said, what do you want from the ISA as a professional body in insurance? Those responses have helped us to tailor-make our value proposition. Don't know if you may have noted that beyond the professional benefits that we have been providing historically, we've now added value-added benefits to the value proposition. A bit more touchable things such as discounts on fees when one is registering at a higher learning institution, discounts on car hire, discounts on accommodation, but also making sure that our career path still remains relevant within the profession. So we've really taken it home and have applied it, and we are still applying it, especially from a human capital perspective. That is a continuous need. As we're working remotely, today we're in the office, some are not in the office, we don't get to see each other. So we try to really make it practical, and we always try to reposition ourselves. Last year, immediately after lockdown, we had to do a quick strategy session with the board to say how are we going to remain relevant in these tough times, and how are we going to make sure that the Institute not only survives 2020, but survives 2021 into the future.
Great, thank you for that. So the last question I have is, in terms of one of the comments that were made is, and we've also picked it up in the trends, our buyers are different, our customers are changing, and their needs are changing. As we see millennials come through, they have a very different approach to insurance, and we've actually seen that in the statistics and how they buy and sell. How are we addressing, whilst we understand that the insurance portfolio itself remains unchanged, if you have an asset, you need to insure it, the asset remains there, the revenue remains there, the people are there in the business, but the attitude to insurance is changing in different sectors of our society. Are we addressing that in any of our training material, in our products and solutions that are being put forward?
Thank you, Chris. I think what we need to do is the point you made earlier, is understanding the customer a bit more. We are at a point where the traditional insurance cover is not going to be relevant anymore. The generation that's going to be our customers, the young, hot and happening, don't need insurance every day. They're kind of forced into buying insurance because of the finance property, perhaps. But we, together with the banking sector, need to work together on how we design relevant products that will meet the needs of the customer that's coming in into the future. And it does mean not only educating the consumer, we need to be re-educated on the way we need to do insurance going forward. The way we've been doing insurance, I mean, I've been in the industry over 20 years now, that ain't gonna work for the future. It will work for a certain segment, our generation maybe, okay, I consider myself part of the older generation, but not for the younger generation that needs insurance on their terms. So we need to get to the point where we do insurance on the terms of the customer. That's why I said earlier, whether we've got the resources, the skills, and the capability to do so is another question.
Great. Thank you for your participation this morning. We look forward to some more chats with you in the panel session later.
Thank you.
Great. So I'd like to introduce our next speaker, and our next speaker is Deolinda Del Carmo. Deolinda is a senior risk manager with 26 years combined assurance experience, who thrives on people diversity to create impactful management solutions. She's also a best practice lawyer, certified fraud examiner with financial compliance certifications, and affiliate membership of the Compliance Institute of South Africa. So, Deolinda, with all of that behind you, I don't know where you start to focus every day.
It can be a challenge, but we learn to focus on what we enjoy doing.
So you represent, or you're with Sanlam at the moment. Welcome to our session this morning. And I'm going to hand straight over to you and ask you to take us through your thoughts.
Thank you. All right. Let's just share the screen like everybody does right at the start. Let me know if all is well.
We are all good to go. Thank you very much.
Okay. Morning, everybody. Very happy to be here, sharing this remote podium with other professionals and having the opportunity to talk about what I'm really passionate about, risk management. As Chris said, I do have a diverse background, but I really am passionate about risk management. But I'm a guru, let's say, you know, when it comes to anything legal, risk, compliance, and governance, those wonderful things that we all sometimes hate to learn about, because, you know, risk management, as we know, is a lot sometimes like paying taxes. Everybody has to do it, but sometimes we don't always want to do it. And isn't a situation like this with a pandemonium, with the pandemic, sorry, well, which it is a pandemonium as well, it's caused a lot of pandemonium. Isn't this a wonderful way to actually find out whether our systems and our risk management is up to scrutiny? So I'm going to talk a little bit about operational risk for insurers in general. I'm going to talk a little bit about, you know, insurers, how they can, how they're very similar to other companies that are going through the same thing. So yes, we are insurers, but we're also just organizations struggling through operational risk. Then I'm going to talk to you about employee benefit providers, which is where I work. I work for Sanlam, but I actually work in the group risk space. So what that means is I'm part of the employee benefits organization and Sanlam corporate, but we actually provide group risk benefits to companies, which are your trauma, your life cover, your funeral cover, your trauma, your illness, and all sorts of things like that. So this is an opportune moment to talk about how the COVID has affected everybody. So I'm also going to talk a little bit about not just the risks that are facing us, but the opportunities that we actually, how we can use this to step up, because as Imsa says, now is the time. So I'm going to share my thoughts with you, engage, let's talk, and the state of our reality, as I said, for insurers, and how we're going to step up. So what is operational risk? I'm not going to go through risk 101, but really it is another way of saying, what are the events that disrupt our flow of daily business operations? And, you know, there are words that we normally use, such as weak process, weak system, you know, ineffective people issues and things like that. But really, it's about taking your business, whether it's an insurance business or whether it's any other type of business, and saying, what are the events that happen that disrupt the flow of daily business operations? And honestly, there are many examples, and we've heard some of them. Cybercrime came in quite high, fraud, obviously, physical events, weather, terrorism, our business continuity, how are we doing on that? Disasters like fires, you know, the short-term insurance industry covers that. Our socio-political uprisings, and then pandemics. Who would have thought pandemics would be on the list? And what we have heard about quite often is the black swan events, the one that we're dealing with right now. Whether it's black swan, gray swan, white swan, we're not sure, but the industry seems to believe that the COVID has been a black swan event, in the sense that it's been unpredictable. It was sort of like, yeah, it might happen, but don't really think so. So we've actually treated it like a bit of an outlier, but in the end, it's actually happened and it's here now. And so what have we done to mitigate and to deal with that as companies? Well, first of all, insurance is a well-established means to prevent, means to transfer risk, or risk transfer to absorb the excesses of risk. And so we ourselves at Sanlam do that. We have reinsurers like the Genres and the Swiss Re's of the world, where we actually transfer our risk to reinsurers. So obviously when these things happen, you need to be covered by insurance. So yes, it requires a robust risk management framework. And as I mentioned, ladies and gentlemen, there is absolutely no better time than a crisis like now to have the foundations and principles of any business tested to scrutinize the true value of risk management. So how have we done? How have we done at Sanlam? Let's find out. Like any other company, I would like to share our experience with you. Like any other company, yes, we are an insurer, but there has been dents in profits massively all across the board. And how hasn't it impacted our people loss? People are off sick with COVID, people are unavailable because families are ill, people are simply stressed out, burnout, exhaustion, mental illness. We heard about it when Thokozile spoke. Absolutely the order of the day. And what happens is there's other things such as cybercrime and fraud, which happens because we're now working in an environment where there's absolutely no control, because every Tom, Dick, and Harry is actually online at the same time. And so logistical and operational challenges ensue. And what can also happen is that our service levels are impacted, because now we're dealing with extra stress and we have fewer people to deal with it. So service levels are impacted, which means that we have to look at more complaints. We have to look at going back to customers and apologizing for delays. And of course, we also have to speed up digitization. This has been, we've been talking about this all the time. And digitization means that everybody now needs to know how to use the internet, how to use Microsoft Teams, how to use and navigate through a webinar, just as an example. And we thought we had to do this, gradually maybe, but now we've had to speed it up. So these are some of the things that companies like insurers as well have had to deal with, just like everyone else in this pandemic. But how are we doing? Well, in the employee benefits industry, or at least in the group risk industry, we've obviously seen underwriting losses that we've never seen before. So let's talk a little bit about that, specifically death claims and disability claims. So because we assist companies, we have, for example, let's say Pick n Pay comes to us and there's 7,000 employees we cover for risk, such as life insurance. So what's been happening is our death claims experience and our mortality rates have been taking a lot of upheaval. What we saw initially in 2020 when the hard lockdown started, it was things were a bit quiet, because hard lockdown meant everyone was at home, everyone was staying away from public areas, sanitizing and, just staying intact and not getting out there and picking up infectious diseases. So the mortality rates in that respect, it was, it still increased, but let's say it was a 100% increase in the second half of 2020. But as we got to 2021 and that second wave, the intensity of that, our mortality rates, in fact, increased by 300%. So you can see that because of we deal with clients, like let's say a Pick n Pay, with many members, these things come through. It came through quite intensively. It's not like we're dealing just with an individual who in the life space. We're dealing with group benefits. So we see these benefits coming through quite a bit. And then what happens is we have a 300% mortality rate increase. So what happens when that happens? Well, before I go on to that, let's talk a little bit about disability claims. One would think, how is disability claims impacted? Well, actually, quite big, because the volatile macroeconomic environment we're dealing with, unemployment, the cost of living, people's morale, all of those things leads to psychiatric claims. Now, I don't want you to get a fright when we use the term psychiatric, but psychiatrics can be quite extensive and quite a complex term. But actually, we can talk about general anxiety disorder, we talk about burnout, we can talk about just exhaustion. And that means that workers are not able to do their jobs anymore, even if it's just on a temporary basis. So we're seeing a lot more disability claims coming through, and we're also seeing disability claims come through as a result of what we call complicated COVID conditions, or the long COVID, as they mention, or they call it. And that means that workers are no longer able to do their jobs temporary or maybe on a permanent basis. So we see that sort of thing coming through, but we're also trying to prepare for this as we're going into the third and maybe even a fourth wave later on this year. So what does this mean? Death claims, disability claims coming in. And how does this impact us as an employee benefit group risk organization or business unit? Well, we have about 300 plus people working in our area alone. And what this means is we stress on our resources. Naturally, people are off sick, people have been deceased, staff are away from work because of psychiatric mental illness issues or other family members who are ill. So they need to be at home looking after them. So what happens is we have more work, more stress, but less people to deal with the backlogs and the delays. And service levels come up now because now we're not doing so well anymore, which means that people are going to industry, other industry organizations like arbitrators and the FSCA and so on to complain about service. So we have to deal with all of these things. And how do we mitigate that? Well, it's the insurance industry. And when risk profiles change, we need to reprice. We need to see how we can absorb the shocks. And sometimes that means looking at other aspects of our product, our types of policies that we sell, and having to trim those down, enhance it, play around a little bit with it. And our claims management interventions, you know, getting more people on board from other areas in the organization or other in our business areas to help. And what we also do is what we call claims triaging. And I think that's something that you probably heard of in hospitals, you know, and they actually do it with the COVID patients as well. You triage, are you red, are you green, are you amber? And we've had to do that because, you know, priorities first. We've also had to take on new hires, and that in itself causes delays because they have to be trained and they're coming in basically under this demanding conditions. So this is some of the experiences we've had just from a group risk perspective. And as I mentioned, I work in that area. I can't really comment on the broader Sanlam group because, I mean, as you know, we're a very huge organization, and I can talk specifically about the area I work in. But what I can say in general is that the brand, and I refer here specifically to short-term insurance, it certainly took a knock from its fight with small businesses over the business interruption claim saga. And so that's been in the news. And but really what we as a group needed to do as a Sanlam group was we had to haul out our reserve and step up, you know, with additional support to sustain the areas that are not growing so much or that are not as resilient as we are. So what I can say to you on a more positive note, in our space, certainly because we're dealing with life, death, trauma situations, funeral benefits, which is exactly what is impacted during a pandemic and during COVID, that despite the disaster, our new business volumes and our values actually have been up from 2019. So that's quite a nice thing. And then, you know, with the level of diversification and resilience in the Sanlam group, we can be carried by our group. And fortunately, we can be carried by our reinsurers as well. Very important. And as a result of that, I think we're doing okay. So what then, having spoken about some of the risks we've experienced in the employee benefits group risk arena and just in general, how can we see opportunities in what's been happening all around us and in the space around us? And I'm actually more excited about this space because I think human beings and companies even are quite resilient, and we do step up. And like Ernst says, now is the time. So how can we as an insurance company, how can we as a group risk outfit, how can we use opportunities to do better, to enhance our products? Well, firstly, insurance pricing. It's been referred to by some of the other speakers this morning. I want to say that insurance pricing, very important aspect to discuss about insurance, because how do we know when our policies are priced correctly for something that's going to happen, an event that's going to be happening in the future? Well, what we've seen is that, you know, uninsured losses on the balance sheet can be an eyesore. And especially when this sort of thing happens, like the pandemic, black swan event, and now we don't have the money to fork out for all the extra resilience that we need. So I think that companies should really gain a better understanding of their risk profiles. And now is the time to do that anytime like a crisis to do that, and to be aware of their risk appetite, so they can be better prepared for adversity. Analyzing costs of employee benefits provisions. As I said, we've seen that there's actually been an increase over time from 2019 to 2021. But I think this is a very specialist process, and it's a very precise process, which really requires a deeper understanding of risk management. So I think companies like big corporates, like a Sanlums and the Old Mutuals and the Discoveries of the world, we can really look at this as a specialist knowledge that we can have and to share with our prospective clients out there. So yes, we need to become the industry experts on this, and we must collaborate more robustly with our group risk stakeholders, with our brokers, with our clients, and talk to the people in the group's risk scheme space particularly, and be more prepared. So I'm not just saying this for commercial reasons. I mean, obviously, Sanlam and the bigger corporates, we need to make a buck or two, and we need to also make sure that, we've got enough money in the pot for when adversity happens. But it's not just about our business requirements and our commercial reasons. It's an absolute must for stakeholders to get together and talk about what's happening at the moment, how we can do it better. And I don't just mean through sending memos and emails. I mean, pick up that phone, do the Microsoft Teams, do the situation we're in now, talk about it, discuss it, wear that risk manager badge and say, how are we going to be a step ahead of the rest? I mean, we see this with fraudsters and cyber criminals who hack. They seem to be a step of the rest all the time, and we need to do the same. And the only way that we can actually create a force to be reckoned with is if we actually have a targeted focus on the things on our solutions. And the only way we can do that is if we have a network of dynamic stakeholders, so that we all know what's going on and what we can do to exploit this damn good crisis that we've really been through. And this is why I see this as an opportunity. Let's not waste a damn good crisis. The pandemic and technology has given us a wide range of people with a voice now. And I don't think that's a bad idea at all. It's so strange that we used to work next to each other, side by side in offices, in little cubicles. And of course, we worked in silos. Although we could go into our colleague's door or knock on the door and have a chat, we still worked in our silos. Now, everyone's online, even from 13-year-olds right through to the people in the 80s, in 81-year-olds, octogenarians, and everyone's got a voice. And the best part is, actually, if you have stage fright about speaking in public, it's not so bad when it's on a Microsoft Teams or a Zoom call. It's not, you don't have to feel so vulnerable, but we certainly can hear your voice, and we certainly can hear what you have to say, because absolutely what needs to happen is that we need to all be risk activists. It mustn't just be the board or the CEO or risk managers like you and me talking about this. We need to get our people involved. We need everyone to embrace this, what's been happening, talk about it, wear the badge, promote what we're trying to do in terms of changing the brand of risk management. Like I said, it's like taxes. Everybody hates it, but they got to do it, So more sustainable solutions can actually be created and I'm talking about an opportunity here to push risk to the forefront on all agendas. And why I say that is that risk is something like pulling teeth sometimes. It's always sort of on the back of our, in the back of the radar. Yes, we know it's important, but we deal with it last, And actually, what really needs to happen is we've got all the opportunity now to show the great, bigger world out there that our new normal means we can justify the necessity of risk management. What would have happened if there was no risk management when this happened? We are being scrutinized at all levels as to see how we shape up. So now is the time, ladies and gentlemen. Forced rapid digitization has meant that technophobia is no longer an option. I can tell you, I'm not tech savvy at all, but I've got to learn. And I used to be afraid of all this technology, maybe because I'm a little bit older than some of you are on the panel. But what this has been telling me is that, how we were scared that robots and artificial intelligence is going to take over everything. I think that if we all become techno savvy, and even people that are now on in their 80s, I mean, my parents are on Twitter, Instagram, Facebook. other parents as well, people that you least expected. Everyone's got a voice, you know. So I think that we shouldn't be afraid of artificial intelligence, or we won't be afraid of it if we get to know more about technology. And then maybe those people that won't take over our jobs. So yes, another opportunity for us is to take employee wellness absolutely to the next level. We've heard that mental illness is now no longer, there's no stigma anymore. Nowadays you have a therapist, you have a psychiatrist, you have an occupational therapist, not just for you, one for your husband, one for your kid, one for your teenager. So basically, employee wellness is a big thing. It means that the opportunities for organizations to take it to another level, so that means companies are, they're making themselves more appealable so that you can come and work for them as good corporate citizens. Employee wellness is a thing. It's huge, and it's okay to have mental illness nowadays. Just talk about it in terms of, I'm burnt out, I have anxiety. Who doesn't? So employee wellness, wonderful way to exploit this as an opportunity going forward, not just for insurance companies, for all companies. And then just, I want to sort of also make sure that interconnectedness of risks is key to understand. And what I mean by that is, this is another way that companies can actually, come to the fore and show how resilient they are. We cannot look at risk in a silo. I mean, look at operations. If people are not working, if people are not available, if people are ill, if people are deceased, it means that there's an impact on our resources. Now we know that compliance resources, for example, is already understated in organizations. We always need more compliance people. But if our company is struggling because everyone is trying to help out where the weaknesses are, that means our compliance risk is impacted. And that means maybe that we won't be able to be compliant in certain respects. So we have operational risk, it moves on to compliance, and we know what happens with compliance issues. I mean, look at our data issues that we've been having. We know that data breaches, I mean, there Poppy's coming around in the next 2 weeks. We know that data breaches can actually lead to losses, huge losses, and it can actually mean businesses can go out of existence. So there we have that sort of approach of operational risk. Oh, now we have to deal with compliance risk, and now our reputation is buggered because we don't exist anymore. And so what does that say about our strategy and our strategic risk? So can we see how risks are interconnected? As a company, there's no such thing as silo, ladies and gentlemen. We have to integrate, we have to connect. And so what we've been dealing with is emerging risks, for example, which have now become opportunities. So these emerging risks, which about a year or more ago was how are we going to work remotely? So it's the new working model. How are we going to deal with remote talent management and the whole issue of work-life convergence, our offices and our schooling and our family life all in one place. These are actually high impact, high velocity risks with the ability to really cripple companies. But I think we've done really well. Most companies are still around, and basically we're showing how resilient we are as human beings. So how do we embrace change, ladies and gentlemen? As companies, as insurance organizations, how do we embrace change? Exactly the way we've done it before. We are so resilient as humans. Look how far we've come. And to think that the online world has become the only place now for human connection. My colleague Dr. Zila spoke about it earlier, that human connection that is so important. But let's look what's happened. We want to change culture, and we're actually doing it, because we change it through our relationships with others, not, like I said, not through emails and memos, although that's part of it. We need to change it through our relationships with others. And before, when we could do that and sitting next to each other in cubicles, we didn't take the opportunity. But look at us now. We're taking the opportunity now while we're all doing remote, because right now the online world has become the only place for human connection. And that, ladies and gentlemen, is how I want to finish off and wrap up and say that at the end of the day, there's all these methodologies and frameworks in place, but humans bring it all together. So we need to have these conversations. We need to have more like this. So we need to have these discussions. And hopefully, we can make this pandemic work out for all of us as an opportunity as well. It's not just bad stories. So that's how I want to wrap up on a more positive note. It's not all doom and gloom. And I know we're running out of time, but I'm happy to take a question or two. Chris, I'm not sure if you have any for me, but thank you very much. Thank you for listening.
Thank you, Delinda. That was really interesting to get your perspective from Sanlam on what's transpired. And it's not that we often have the opportunity to understand how one of the insurers actually have dealt with it, what the impacts have been, what you've had to do about it, and the various processes and things that you've had to work through to obviously make sure that you're still around, resilient and sustainable for the rest of the market as they need you going forward. So I appreciate your contribution. I have one question. You raised something which hasn't yet made its way to the fore this morning, and that is the topic of reinsurers.
Yes.
So in the conversation, you raised an interesting point that obviously an insurer takes the risk up front, but there's always somebody else that they reinsure that business with. And there is a certain train of thought that goes in the market that says, well, if insurers hold such a small amount for their own net retention, should the customer in the street not have the opportunity to engage with reinsurers on their profile? Because the thought process is if reinsurers are dictating the premiums and the covers allowed to be written by insurers, why can the customer not move closer to the reinsurer? What's your views on that?
Who says the customer can't move closer? I think reinsurers really need to open up that dialogue, just like, I mean, reinsurers are also companies, just like us as insurers and just like all the other companies we heard about this morning. So, you know, in the same way, they also have to start dialoguing and understanding what customers need, how they're going to collaborate with their stakeholders. And I think if they want to stay relevant and if they want to also stay, you know, they don't want to be out of pocket, they also need to find out what do customers need? What are they really seeing? And at the end of the day, we have to make sure that as Sanlam or as an insurer ourselves, we have really good collaboration with our reinsurers. I see no reason why that is not something that can happen. I don't think that we would have anything against it at all. I think that because we're dealing with a black swan event, pandemic, there are many ways in which, you know, we can enhance what we need to do. And perhaps the traditional way of doing things needs to change a little bit because we need to step up and do things a little bit differently. So I don't know if that answered your question, but I'm more about positivity and collaboration. And if we can help our customers, you know, with treating our customers fairly, it's something that happens, you know, extensively in the insurance industry, policyholder protection rules and treating the customer fairly. We have to hear the customer, we have to hear the other side. And I think insurers and reinsurers need to look at that to enhance their profile in the industry.
Thank you for that. Yeah, it is interesting because the legislative framework and obviously the industry rules don't always make it possible for customers to get to that level of engagement. But it would be an interesting dialogue if our customers could have direct relationships and build those relationships over time through demonstrating positive risk profiles. We do understand, I think Jane this morning in her presentation said, you know, how do we attract a good renewal? And some of the points that she mentioned, one was present to your insurer. So in the market fraternity, in the broking fraternity, it's not always that you would see a customer engaging directly with an insurer because the broker is the intermediary. But I do like the thinking that customers who are using brokers should have the opportunity to engage with the insurer and put their own case forward. Understanding the intermediary has the knowledge and experience, but they are not the customer, and therefore the customers should be at the table.
But then, Chris, then it's up to us as insurers to pave the way. You know, if the intermediary is the go-between between the client and between the company, then we need to make sure that we understand the client's needs first of all, and we do. Often we look at our complaints processes, we look at our TCF issues and things that's happening in the industry to learn about what the customer needs. And then the insurer goes out and educates the broker. So we're all stakeholders in this together, and we need to make sure that there's a cohesive approach, collaborative approach. So I really think that, where we see opportunities, we need to go that extra mile and make sure that it's happening. Educate your brokers so that they can ask the right questions of the clients, and make sure that you sort of a cradle to grave approach, cover all your bases.
Great. Good. Thank you so much for your insights. We appreciate it. And we hope to be chatting to you on the panel in a couple of minutes.
Thank you.
All right. Good. I'd like to introduce our last speaker for the morning. So Darlington Manawani is joined Allianz Ghana on December the 1st in 2017 to assume the role of the CEO of the group, of the company, and responsibilities for non-life insurance. Darlington is an insurance practitioner with over 25 years experience gained in Botswana, Swaziland, Zambia, Zimbabwe, and South Africa. He joins Allianz from Aon, where he was the regional director and controller responsible for global and multinational clients. Darlington is an associate of the Insurance Institute of South Africa, and he completed the program for management development from the Gordon Institute of Business Science and the University of Pretoria. He's held various positions in charity and business clubs, such as the Rotary and Toastmasters International, where he's the past president. So I'd like, Darlington, are you online? Please, if you're welcome to put your camera on and unmute.
Yes, I am, and good morning. Thank you very much. It's good to be here. So I think the ladies have spoken, Chris, the ladies have spoken eloquently on all the points that I wanted to raise. So my task is just to run through 3 or 4 slides to bring you up to speed with the Ghanaian market, as well as to talk about the 2021 Allianz Risk Barometer. Prior to COVID, I used to run, but walk a certain path just to get my heart rate up. And I used to pass through a construction site. And I really never thought much of the construction work and the construction people or the construction staff until COVID struck. And the reason why I started thinking a lot more closely about the construction employees is the fact that they use helmets and they are well kitted for everything that they do. And I juxtaposed that situation to, an office environment where we walk gingerly every morning and we don't worry about risks and everything around us seems normal and we go about our day without considering risks. So with that background in mind, I just wondered whether our world would be different if our employees, our staff, and people around us knew what was happening in the global world. We knew what was happening in the bigger world as far as risk is concerned. And this is why I wanted us to start off with the Allianz Risk Barometer for 2021. So if we can, next slide, please. So the long and short of the results of the 2021 Risk Barometer indicates that business interruption, pandemic outbreaks, and cyber incidents are really the terrible trio that are causing a lot of havoc in the risk world, in the insurance world, in the business world. If we understood this earlier, would we be forearmed, as it were, to deal with these risks? I don't know about pandemic, but business interruption to some extent, yes, and cyber incidents to some extent, yes. And these 3 risks really cut across the whole world. If you look at the Europe, the Americas, Africa, and Middle East, it's the same story. It is the same story. Those are the top 3 risks that we are talking about. So when we talk about operational risks, I think we need to understand the bigger world in which we operate in and see to what extent it affects the operational world of our clients, the operational world of insurance companies, and the operational world of us as individuals. So moving on. Now, we have identified the 3 risks that are affecting all of us, but which sectors? The top 5 business sectors, particularly in Africa. Agriculture is affected. Financial services, a lot more perhaps than agriculture because of cyber incidents, pandemics, and business interruption. And because we all hail from the financial services sector, we can speak a lot more aggressively and passionately about the impact of those 3 because they are external and they are also internal, external in the sense that they affect our clients and impact our businesses. The hospitality industry or tourism in general has been heavily affected. You know, a lot of countries' economies, in Kenya has been decimated because most of their, collections are from the tourism sector. So I think it's important to understand the risks. It's also important to understand where they sit in terms of impacts within the bigger economy before we start looking at our individual companies and our individual selves. I want to talk briefly about Ghana. So, of course, the pandemic, like everywhere else, significantly curtailed Ghana's economic growth. Real GDP was estimated to reduce from 6.5% in 2019, at the close of 2019, to 1.7% at the close of 2020. I don't have the latest numbers, to show you where we ended in 2020, but 6.5 to 1.7 is a significant reduction in growth that impacts not only the financial services sector, but all the other sectors that make up the economy. In 2021, of course, there's a projection that the economy will grow to 21%, to 4%, I wish it was 21%, to 4%, and then marginally to 4.1% in 2022. Inflation will ease to 8.2% in 2021, and 8% again is the same number in 2022. So I just want to quickly take you through the Ghanaian market for those who have clients that are traveling across the world and coming into the western part of the continent. Ghana currently has got 29 short-term insurance companies in a market where the total market size in terms of gross written premium is northwards of $350 million. Already you can see that there is intense competition around wrestling clients, and most of that competition is not necessarily based on value, but around pricing. So when I hear my colleagues talking about South African market being a hard market, on the other side of the continent, we're dealing with a soft market for all locally retained risks. But of course, when you start tapping into international reinsurers and the like, that's where you feel the pinch in terms of pricing. In terms of the insurers and trends that we are seeing, and I'm quickly running through this, the trends that we are seeing. So there are changes in legislation or enforcement of existing legislation. One is the fact that the minimum capital requirement has been revised upwards from $3 million US to about $10 million denominated in local currency. Of course, marine imports from the beginning of this year will become mandatory, that they are insured with local insurers. So if your client rocks up with an international certificate of insurance on marine, guess what? They will be required to localize that cover, before the paperwork is processed. So it's important that you look into this. I think one of the things that has been talked about a lot more extensively earlier is around the performance of the insurers, which is tied not necessarily to capital, but also other forms of capital, including human capital. There are lots of qualified people within this market and very competitive, could compete on the international as well as regional scale. But the challenge is to translate all that to benefit the client and make sure that we're using all the skills that we have to jointly create solutions and to make sure that there is no misalignment of expectations between ourselves and the clients. So these are some of the things that are happening in the market. Issues around digitization, really, everyday issues to try and bridge the gap that has been created by COVID in terms of interface with clients. But Ghana is one of those places where people value the human interface, and I think it's common across the whole of Africa. But the biggest question that I have is, are we ready, to use digital interface in place of human interface? Because there are budgetary constraints, there are business interruption constraints around connectivity also. Business interruption in the sense that sometimes you can't start a call and finish it off without any interruption. So that is a form of business interruption, especially to the micro, to a micro client, or to a micro business operator. So things to consider. Now, when we, just coming back to Allianz, some of the things that we came across and that we are still grappling with in the market, I did mention competition that is largely based on pricing, challenges with staff, operating from home, and just helping them to understand that this is the new way of doing things. These are some of the issues that we're dealing with. We have worked on it extensively, but still, a long way to go. I think everyone can't wait for COVID to end, and I'm in that bucket too. So, Chris, without taking too much of the time, I want to yield control back to you, and thank you for having me here.
Wellington, thank you very much for your insights. Very interesting to hear how things are transpiring in your part of the world. I have a question for you, and perhaps if you could share with the audience, from an insurer perspective, a short-term insurance perspective, Jane shared with us this morning what's happening in the South African context in terms of premiums and in the various classes of insurance. But if you look specifically at property, 15 to 20% increases on premiums since this year, but going back since 2018. I'd like to ask you, as an insurer and having been responsible for global clients and very large corporates, what is the rating criteria? How does Allianz look at a client, and what are the key issues for you looking at a client when rating a client? We have a lot of clients on the line today, some 150, 141 participants at the moment. And I think a lot of people are sitting there saying, what are the key issues that insurers are looking for when they look at my profile? Could you just give us some insights as to how an insurer works, please?
All right. So put simply, if you look at a local client, and I think the requirements are not different between a local Pan-African client and a global client. It's how you manage your risk and how intimately you are involved in the management of that risk, and continuously removing elements or managing elements of the risk that could see you having a loss. I think an insurance contract is one of those contracts where both the insurer and the insured don't want what they're insuring against to happen. So I couldn't tell you that risk management is not important, because it is. And it goes beyond just paying lip service to the process, but being actively involved and working with the insurer to demonstrate that whatever it is that you intend to do to improve the risk is actually being put in place. So that applies in Ghana as much as it applies to South Africa and globally. And my experience globally was not different when I worked for Aon. The requirements were pretty much on risk management. And I think the spotlight, will be put on risk management going forward, given the impacts of, COVID on businesses in the last year that we have been dealing with it.
Good, thank you. And then a last question I have is, in your particular area, your geography where you're operating, what kind of clients' premium increases have you seen, if any, in the market over the last couple of years?
Well, Chris, the beauty of Ghana, and I've been here for 3 years now, is that it's a tariff market. So there hasn't been any revision of the tariffs in the last 3 years that I've been here. And really the tariff rates are probably 3 times the price that you pay for a similar risk in South Africa. Not that you have similar risk, because the profile of the local clients is very different to South Africa. But generally speaking, 3 times more, 2.5 times more is the range that you're looking at. But when you look at domestic policies, for instance, motor insurance, that's a different story altogether. I mean, that is always changing, even though there is a tariff, that is always changing in line with the loss ratios.
Good. So the message is, if you want to keep your premiums down, don't move your business to Ghana.
Well, I wish I had the capacity to provide to all the insurers in South Africa that cannot localize some of that capacity. Then I'll charge you 3.5 times and make lots of money.
Great. Donington, I appreciate your comments. We're going to move straight into the panel session, which is the last session of the morning for the last 10 minutes. So thank you for that. I now invite all the panelists to come back up on camera and also on speaker, please. Great. So first, thank you all for the contributions you've made this morning. We are back on time. We literally have 10 minutes before we close at 11 o'clock. So I think we've caught up a little bit of time, and I do appreciate your time that you've given us this morning. There are a number of questions that are obviously popping up on the chats in the Q&As, and we unfortunately just can't attend to all of the questions. So I think what I'm going to do is I really have about 2 or 3 questions that I've just made a couple of notes on, and I'm going to try and just go around, do a round robin, and ask everybody. I might run out of a question, so maybe Donington, you might be the luckiest. You had the last question. I might not get back to you with another one. Jane, I'm going to start with you because there was a question about brokerage that came through that said, what are brokers doing to motivate additional investment in establishing improved risk information from clients? What are we doing in the broking fraternity, or what are you guys doing as Marsh when you engage with clients to say, it's critical to your renewal that we get the highest level of risk information? What kind of conversations are you having with clients to get them to understand that risk is so critical in the premium, and what you need to do to gather that information to present the best profile to the insurer?
Look, I think, again, ideally, it comes back to having that quality information. I mean, we work closely with the risk consulting team. It's good to have that set of eyes on your risk, because yes, an insurer is going to say, I want the Rolls Royce, I want this, that, and the other. But you know what, sometimes things can work in a different way and a more cost-effective way. And I'm not a surveyor, but I've been on site. The client's required to do X, they get a fire consultant in, they sell them Y, they spend a fortune, and you come back a year later and the market says, well, actually, I didn't really want you to spend all that money. You could have spent half and got the same results. So I think it's important to own that process, to work with the broker and the insurer. And I mean, insurers are open to discussion and looking at different things. So I think it's all working together to the same cause, to get the same results, but it's also, looking at alternatives. A sprinkler may not be an answer to everything, and there are different ways of doing things. And I think that's important to have those conversations. And again, insurer, broker, risk consultant, and client to all agree on the way forward.
Okay, great. Thank you, Jane. So I'll just continue with the same line of questioning. Tarashni, we had a question, or there's a thought here that says, South Africa is currently experiencing some significant challenges with regards to load shedding and also in the field of water supplies. So we know that our infrastructure is really failing and we're struggling, and that's leading to claims. So On the electrical side, we see surges, we see damaged equipment, through the load shedding process. And then on the firefighting side, there really is a challenge for clients to actually, have access to water to fight fires when these things happen due to the condition of the municipal mains and the hydrant systems and things like that. So the question is, how are insurers responding to the challenges that our clients have? And what is the right approach? What should our clients be doing about it?
Yeah, so that's a good one. And that's really a hot topic in the whole risk engineering fraternity. And really, when you look at how insurers look at a risk and how they rate them, particularly if it's a high hazard occupancy, fire protection and water supply are really two of really critical indicators that move the dial in terms of, the insurers thinking around capacity placement, risk management, and determining premiums. So it's a real position that clients find themselves in. And I guess what we have is we have risk engineering professionals out there that have a number of technical codes and guidelines and standards for which it can be read and can be interpreted and can be applied alternatively to solve a client's solution. So yes, you may have a system, or you may have an electrical system that you need to protect, but there are also alternatives to fire protection systems that need water supplies. There are gaseous suppression systems. There are different types of water mixture systems. There are different types of alternative fire protection systems that are out there that clients should be aware of and be made aware of by the partners they engage for their risk engineering and risk management consultant. I think in the interim, not every client has access to capital to investigate these systems, for the advice of fire protection engineers, is really to, as I explained before, go through the risk cycle, look at those systems that are critical, identify where the gaps are, see how we can mitigate the risk in the meantime by the use of readily available fire protection systems like fire extinguishers, maybe 24/7 monitoring, or coming up with a system where we can utilize the resources we have on site. It is a real challenge. It's something that insurers are aware of, but I think, where it's a bigger occupancy and where there's bigger risk to not having those water supplies there, what insurers are looking for is comfort that it's top of mind, that there's CapEx being allocated to it. It may be part of a long-term project, and that there is interim mitigation risk measures in place.
Right. Thank you. Let me go to Delinda. Perhaps we go back to an insurer and ask an insurer question. So one of the things that keeps coming up in conversation, and again in some of the questions today, I could ask this of Darlington, I could ask it of Jane, I could ask it of you, and I'm sure you all have good answers, and perhaps we'll ask one or two people the same question. Is one of the frustrations clients have is they receive a set of risk improvement information from an insurer once the risk has been graded. So the insurer looks at the risk and says, in order for me to underwrite this risk and provide you with a premium and a deductible of this nature, these are risk improvements that you need to make. And I expect you to do those within a period of time. The challenge herein is that should at some point into the future, the intermediary or the client decide to change insurer, they are very frustrated by the fact that the next insurer has a different set of requirements. So whilst they think they've addressed it the first time with one insurer, they get to the next insurer and there are a completely different set of requirements that require capital expenditure. Is there any way for insurers to find a common understanding of what the key risk improvements are so that clients don't have this challenge when they're moving markets from one to the next?
Look, I think that, in the group risk space, there's only a few really, organizations that client can shop around in. I'm talking specifically, obviously, for your Pick and Pays and your bigger clients with 5,000 employees and the like. So if it's not going to be Old Mutual, it's going to be Discovery, or it's going to be Metropolitan, or MMI, or I think you understand what I'm trying to say. So obviously, these types of companies, they need to, yes, have that conversation together and look at how consistently we can speak the same language. However, I also think that there's lots of competition, and the one insurer wants to be a little bit above the rest, and that happens all the time. And clients also have, they have a right to shop around and look at what they like here and what they don't like at the other insurer. And brokers here play a huge role, because what happens is the broker often is an advisor or assessor for all 4, 5, or 6 companies. So they know exactly where the upsides and the downsides are, So I believe that anything's always possible. But on the other hand, there must also be the commercial right of insurers to do things a little bit differently and to distinguish themselves from each other. Because how on earth, if you have exactly the same consistent approach with regards to risk assessments and improvements, how on earth is the client going to know which brand am I going to choose? So I think it's a combination of things, and really, again, stakeholders play an important part in cohesively bringing it all together. And I think it's going to be interesting, in this new normal, to see how this plays out, because we do have to have in conversations where we're offering the same thing to customers. It doesn't make sense to confuse customers, but I think there's a balance. Commercial right, competition on the one hand, and on the other hand, this consistency, so that, we're not all completely off the ball. There needs to be a sort of a general, this is how we will deal with it, but this is how we're going to streamline, or this is how we're going to increase or decrease the notch. So a balance, I would say.
Thank you.
And Chris, I might add that, putting on my broker hat, I think it's important for the 3 parties, the client, the insurer, and the client, the insurer, and the broker, to collaborate effectively whenever there is a change in service providers, to make sure that there is consistency in the assessment of the risk and prioritization of things that require attention, because there is CapEx involved. And usually whenever there is a risk improvement, it doesn't correlate with a premium reduction or a bursary being given to a client. So all these things need to be discussed. And I think clients that now employ risk managers within their companies have got a better chance of getting some of these things done systematically, rather than, with all due respect, a CFO acting as a risk manager when he's probably not kitted for that job. So it's important, just to summarize, it's important for the 3 parties to collaborate and make sure that we are not alienating the client, we're actually helping them, to improve, because risk is not static, we agree, but it must also recognize that there are monies of budgetary constraints that need to be considered.
Right. Darlington, thank you. That's an interesting point. It was a question that somebody posed. So I think we all understand that whilst there is, a certain point to which we want to get the risk profile, it's not always possible to get there in the short term. And therefore, we can assist clients with implementing other risk mitigation principles whilst we are budgeting perhaps for capital expenditure in the long term. But my question to you is this: as an insurer, where a client has a financial constraint and a risk requirement is on the table which requires significant capital expenditure, is there, on the side of the insurer, any understanding for a long budgeting process to mitigate that risk? Or is it something that clients need to understand has to be dealt with in the short term?
I guess it depends on what we are talking about. If you look at the risk level versus the improvements and the chances of a loss, you are going to insist on that CapEx to be spent, because if you don't, you end up with a big loss. But if really it's, the benefit is of such a nature that you can spread it over time, then that's where the dialogue comes in, so that the 3 parties can agree on a time frame, all the parties.
Great, thank you. Last 2 questions before we go. Jane, we picked you again because you're the broker here today. So in the Sub-Saharan market report that you referred to earlier, it talks there about the property rates having increased, call it 15 to 20%, all right? And then it also goes on to say that we've had 14 consecutive quarterly increases in premium, the longest run that we've seen in the market. So if you're a client and you have good behavior and you've got a relatively stable business and your insurance needs haven't changed from one year to the next, how can you help the broker achieve a flat renewal for you?
I think, firstly, we all talk about the market, and it's a reason because the market's where it is, and that's why we're seeing the increases. And, my risk hasn't changed. I'm a good citizen, or whatever, and there's always that frustration. So I think it's cold comfort, but we've all enjoyed the market cycle when it was reducing. So everyone got reductions, and probably the better risk got the better reduction. But I think it's a case of it's very risk. The first factor is your underlying risk. Is it a hazardous risk? Is it a benign risk? If it's a benign risk, there is still capacity available. Renewals are a lot easier. If it's a hazardous risk and it comes back again, and we're talking about the approach to the risk management, time frames, own your own risk program. Show the market you are in control of it. Yes, as you said, you may get markets that say, I want this done first. The other one says, I want that done first. If you can show you're on a path, and it may not be perfect, and insurers understand that. And I think they are willing to work with you, provided it's not a case of, well, I'm going to do it next year, and then next year comes, and I'm going to do it the year after, I'm going to do it the year after. If it's a 3-year time frame, but we've got a plan, we're owning it, we're dealing with it, they will generally accept that. So it's being in control of your own risk journey versus, you'll be in a stronger position if you come across to the market like that, show them what you're doing. Yes, there may be tweaks along the way, but owning it and communicating that you're on top of it. You don't want to be driven by the insurer. Yes, there are requirements, but own the program yourself.
Agreed. Thanks, Joanne. Takazile, we have not forgotten about you. So the last question is to you. And that is that there seems to be a disconnect that people refer to in the industry between the client's understanding of what insurers want, the insurer's understanding of the profile of the client, and somewhere in between there, do brokers really get the training that's required to understand how to assess a client's business in detail from a risk perspective, and we're talking operational risk perspective. So the question to you is thus: is there something in the training that IISA provides that could address closing some of those gaps for brokers to get to understand how to do more in-depth risk assessments for clients, to get to know their business better, and to position that in the right profile to insurers when they're taking those profiles to insurers for quotes? Is there something that can be addressed through IISA, through training, to close some of those gaps, is the question.
Thank you, Chris. Yes, there is. We do offer basic 101 commercial insurance practice, personal insurance practice. We offer intermediate, and we offer advanced as well, which looks at really the basic principles of understanding a portfolio, analyzing, identifying the risks, and really making sure that the engagement with the client is relevant and not one way, but it's a true engagement, and making sure that the quotation or the proposal that's going to end up going to the insurer is a true reflection of the meeting of minds between the broker and the client. It is I think what we are experiencing is a flaw, the negative of the digital environment. I think most of the basic principles we were taught when we joined the industry are now automated. The computers do the thinking for you. So we need to go back to the basics and start building back those insurance technical expertise in understanding the risks, identifying them, or helping the clients to even identify areas that they may not be aware of that need mitigation through insurance. So yeah, we do offer that type of training, and it's really a matter of going back to the basics and learning the insurance practice.
Great, thank you. So I think before I close, just a caveat, you know, a lot of broad sweeping statements have been made through questions today. I think it's just important for the audience that we all understand it's not a reflection of every part of the industry. There are some insurers that are extremely close to their clients, some brokers very close to their clients, and some clients extremely knowledgeable about insurance. So it was really for the benefit of the broader audience. Thank you all of you for your participation. I appreciate your time this morning. And for those of you members that are still on, there's still 110 people on the line. Please remember to do the survey, which will be released straight after we close the session, in order for you to win those tickets to the virtual conference. To everybody that's joined us, thank you and have a great day.